They are sitting on the single easiest trillion-dollar trick in modern finance, and they still have not pulled the trigger. I am talking about the US Treasury revaluing its gold reserves overnight, creating new money out of thin air without printing a single new dollar bill. It sounds impossible. It already happened once before, in 1934. And the moment they do it again, gold could be repriced not to $5,000, not to $6,000, but potentially to $15,000, $20,000, even $25,000 an ounce, just to make the math work. Stay with me because by the end of this video, I am going to walk you through exactly how this trick works, why one of the most experienced wealth managers in the world believes it is only a matter of time, and what it means for your gold and silver right now. Welcome back to Macro Bullion. I am Alex James, and on this channel we break down gold, silver, and the global economy the way an independent analyst should, no sugarcoating, just the numbers and the reasoning behind them. Before we get into today's topic, if you are new here, hit subscribe because we cover moves like this before most of mainstream media even mentions them. And if you want to stay until the end, I am going to give you my own read on where this leaves gold and silver heading into the rest of 2026. Today, we are unpacking a conversation with a retired Swiss-based wealth manager, someone with close to 50 years of experience managing money through currency crises, banking crises, and multiple gold bull markets. He recently returned from China, and what he described there tells you a lot about where the global economy actually stands right now. Not the official headline numbers, the real on-the-ground picture. Luxury malls built in the last 10 to 15 years. Beautiful, modern, filled with electric SUVs that cost less than half what you would pay in Europe for a similar car. But walk into the actual stores and they are empty. Shopkeepers standing at the door waiting for a single customer. People are in the mall, but they are there to escape the heat and socialize, not to spend. That is what a slowing economy with cautious consumers looks like from the ground, not from a GDP print. Now here is why this matters for us. This conversation was not really about China. China was the opening. The real subject was the United States, the US Treasury market, the US dollar, and what happens to gold and silver when trust in government debt starts to crack. As of today, gold is trading in the $4,000 range per ounce, and silver is sitting close to $58, both up sharply over the past year. But the analyst's argument is that the fundamentals behind that move have barely started to play out. So let's get into the background of why the system is under this kind of pressure in the first place, because that is the foundation for everything that comes next in this video. Let's set the stage properly. For decades, investors operated on a simple, almost unspoken belief. Governments can borrow as much as they want without real consequence. Central banks can create money without destroying confidence in the currency. And tech stocks and equities can basically go up forever, no matter what happens in the background. That belief carried markets through multiple crises. But as we move through the second half of 2026, that belief system is starting to crack, and the real question shifting from which stock or which sector will outperform next to a much bigger question: how do you protect and grow your wealth as the financial system enters a stage that could be far less forgiving than anything we have seen in the last 40 years? The background here starts with debt. The United States is currently running a deficit of roughly $2 trillion a year. Out of that, around $817 billion, close to half of the entire deficit, is going purely to interest payments on previously issued debt. Think about what that actually means. The government is borrowing money just to pay the interest on money it already borrowed. That is not a one-time event, that is a structural pattern. And as older, cheaper debt matures and has to be refinanced at today's higher rates, that interest bill only grows. The 30-year Treasury yield has been sitting around 5.1%. And according to the analyst, once that yield pushes toward 5.5% to 6%, that is the zone where governments and central banks start getting seriously worried, and where they typically start stepping in. Now here is the important nuance most people miss. There is no fixed number, no magic debt to GDP ratio, where a crisis is guaranteed to happen. The Maastricht Treaty set 60% as a limit for European countries, but Japan sits above 300% debt to GDP and has not collapsed. The point is not the number itself, the point is sentiment. Confidence can hold for a very long time, and then it can break extremely fast, far faster than the underlying numbers suggest it should. All it takes is one unexpected event, one policy mistake, one bad headline, and within months, large holders of government debt can start heading for the exits. We actually saw a live example of this a few years back in the United Kingdom, during what is remembered as the gilt crisis. A new government budget spooked the bond market. Pension funds, which had been using derivative-like instruments to boost their yields, suddenly faced margin calls they could not meet as gilt prices fell. The Bank of England had to step in and buy gilts directly to stop a chain reaction that could have wiped out major pension funds. That is the kind of sudden, sentiment-driven event that can turn an orderly bond market into a crisis within days. And this is exactly the kind of scenario analysts are now watching for in the US Treasury market. So, what happens when a government reaches that breaking point? And more importantly, what tools does it actually have left to respond? This is where we get to the real problem at the center of the entire global monetary system right now. When a government's borrowing costs keep rising and its own citizens or foreign buyers start demanding higher and higher yields to keep lending, the government eventually reaches a point where it simply cannot keep affording its own debt. In the analogy the analyst used, it is like constantly borrowing from Peter to pay Paul, and then having to borrow from Peter again just to make the next payment to Paul. At some point, Peter says, I want 5.5%, then 6%, and eventually the government has to ask, at what point can we simply not afford this anymore? Every central bank and every government has contingency plans for exactly this scenario, the same way a building has an evacuation plan for a fire. The real question is never whether a plan exists, it is whether it actually works when the moment comes and whether it gets implemented fast enough. One likely response, according to the analyst, is that the Treasury essentially instructs the Federal Reserve to step in and buy government bonds directly on the open market, supporting the price and capping the yield. Once large financial institutions see the central bank doing this, they treat it as a one-way bet. Buying bonds becomes safer because they know there is a buyer of last resort underneath the market. But there is a second, much more interesting tool available, and this is the trillion-dollar trick I mentioned at the start. The US Treasury currently holds gold reserves valued on the books at a price fixed back in 1973, just $42.22 an ounce, wildly below today's actual market price. The idea is simple on paper. The government legally revalues that gold to a much higher official price, and in doing so, instantly creates a massive amount of new value on the government's balance sheet without printing new currency in the traditional sense. This is not theoretical. It already happened once, on January 31st, 1934. The government forced the Federal Reserve to sell its gold to the Treasury at $20.22 an ounce. The very next day, the official gold price was raised to $35, instantly handing the Treasury a 65% profit at the Fed's expense. In exchange, the Federal Reserve received something called gold notes, paper that is not redeemable in gold, not redeemable in cash, bears no interest, and is still sitting on the Fed's balance sheet today. The mechanism to repeat this today would involve a sale and repurchase agreement between the Treasury and the Federal Reserve, created through legislation similar to the Gold Reserve Act of 1934. Here is why the number matters so much. A common estimate puts total US Treasury gold holdings at around $1 trillion at today's prices. But $1 trillion is genuinely small compared to a $2 trillion annual deficit and a debt load in the tens of trillions. For this trick to meaningfully move the needle, some analysts argue gold would need to be revalued 3 times higher than current levels, somewhere in the range of $15,000 to $25,000 an ounce. That would not fix the debt problem permanently, but it could buy the government another 10 to 15 years before the same pressure builds up again. Now let's get into what this actually means for gold, silver, and how the two are behaving relative to each other right now. Let's talk numbers, because this is where the story gets very real. As of the past few days, gold has been trading between roughly $4,020 and $4,080 per ounce, based on data from CNBC and Trading Economics. That is a meaningful pullback from gold's all-time high of $5,602.22 hit on January 28, 2026. Silver has followed a similar pattern, trading around $57 to $58 an ounce this week, well off its own record high of $121.67, set just one day after gold's peak on January 29, 2026. Both metals have cooled from their January highs, but both are still up substantially over the past 12 months. Gold roughly 24% higher year over year, and silver up over 100% from where it stood a year ago. One thing the analyst pointed out that deserves real attention is the changing relationship between gold and the global money supply. Historically, gold has moved closely in step with the amount of money circulating in the world's major economies. But toward the end of 2025, that relationship visibly diverged. Gold price action pulled away from what the money supply alone would predict. Part of the explanation lies in how the very definition of inflation has shifted. Inflation used to simply describe an increase in the money supply itself, with rising prices as the symptom. Today, in a world where most consumer goods are available in near unlimited supply thanks to global manufacturing capacity, printing more money does not necessarily mean everyone rushes out to buy double the groceries. The old, tight link between money printing and consumer price inflation has weakened. What has replaced it, according to the analyst, is a shift in why people are actually buying gold in the first place. It is no longer simply framed as an inflation hedge. It has become what he calls the asset that gets you to the other side of a reset. The idea is that at some point, something in the system breaks, and governments are forced to restart it in some form, whether through higher forced inflation, capital controls, a rationing style system, or a full monetary reset involving something like a central bank digital currency. In any of those scenarios, the ones most exposed to losses are typically holders of government bonds and large cash holders, particularly foreign holders. Physical assets you can hold, touch, and use, property, equities, and now increasingly gold and silver, are viewed as the way to preserve wealth through that kind of transition. This lines up with the analyst's own portfolio moves. Going into 2026, he trimmed his equity exposure from around 55 to 50%, citing stretched valuations while increasing his allocation to gold and silver and adding a small 1% position in Bitcoin, not because he is bullish on Bitcoin specifically, but because after its run to the $100,000 level, a small tactical allocation made sense as one more hedge in an uncertain environment. Now, with all of this laid out, the fundamentals, the debt problem, the gold revaluation option, and the shifting narrative around gold, let's talk about where this actually leaves us heading forward. So here is my analysis bringing all of this together. The core argument is not that gold's fundamentals have suddenly improved in the last 12 months. It is that they simply have not gotten worse, and in several areas, they have quietly gotten stronger. Inflation expectations have risen. Government indebtedness has increased, not decreased. War-related spending in the US has added tens of billions of dollars in additional costs. None of this is new information. Most of it was predictable a year ago, but predictable and priced in are two very different things, and the market appears to still be digesting what a debt to GDP trajectory like this actually means over the coming years. What is genuinely new is the shift in psychology. Gold is being reframed from simply an inflation hedge to what the analyst called the asset that gets you to the other side of a reset. That is a meaningful shift because it changes who is buying and why. It is not just short-term traders anymore. It is central banks, sovereign wealth funds, and increasingly retail investors who are thinking in terms of systemic protection rather than short-term returns. On the prediction side, several major banks have already put numbers on the table for where gold could head by the end of 2026. JP Morgan is forecasting $6,300 an ounce. Deutsche Bank and Societe Generale are both around $6,000. UBS is at $6,200. On the more conservative end, Commerzbank has actually trimmed its year-end target down to $4,500 for gold, while still expecting silver to reach $67 an ounce. That spread between forecasts tells you something important. There is real disagreement among professionals right now about how fast this next leg plays out, but almost none of the major banks are calling for gold to go significantly lower from here. My own read, and this is not financial advice, just how I am framing it, is that the gold revaluation scenario is a low probability, high impact event. It is not something you should base your entire strategy around happening this year or even next year, but it functions as a kind of insurance policy sitting underneath the entire gold market. Even without it, the structural story, unsustainable deficits, a shrinking pool of buyers willing to absorb new treasury issuance at current yields, and a slow but real shift away from blind trust in government debt is enough on its own to keep the long-term case for gold and silver intact. The pullback from January's highs is not necessarily the end of the move. It may simply be the market climbing what the analyst called a wall of worry, the normal choppy path that every genuine bull market takes. That is where I will leave it for today. If you found this breakdown useful, make sure you are subscribed to Macro Bullion because we will be tracking every one of these developments, the Treasury gold revaluation debate, the 30-year yield, and where gold and silver head next right here on this channel. Drop a comment and let me know, do you think a gold revaluation actually happens before this cycle is over, or do you think the Fed and Treasury find another way out? And as always, this video is for educational purposes only. It is not financial advice, so please do your own research and speak with a licensed advisor before making any investment decisions. I will see you in the next one.